Who's this? Oh, you're an entrepreneur? Oh, you're a real estate investor. Oh, you're trying to learn from those who did it. Well, come into the lab then. Put your white coat on, gloves on, notepad, and let's build, y'all.
Real estate experiment. What is happening, y'all? Today we have special guest, Darin Batchelder. Is that correct? Did I get that?
You got it pretty close. It's Batchelder.
Yeah? Batchelder, Darin Batchelder.
Yes.
So I wanted to make sure. I know I got a little cute on that last pronunciation.
You were close, my friend.
No, but it's most important thing is someone's name. So we want to make sure we get that right. But most importantly, you came off as genuine. We connected. We're just talking about the power of social media. Like if you're listening to this right now, it is what? March, is it 30th today? March 30th. Right. And obviously as we know, a lot of us are right now quarantined, but and Darin's based out of Texas, and I can't wait for him to really just get a chance to introduce himself. But we're here, we're doing it from a distance, and luckily we can still connect with wonderful people like Darin. And Darin, I'm very stoked to have you in the lab with us, and so I'll let you introduce yourself because you have a very, very interesting background that I think gives a nice trajectory of how you've been able to put it together, which we really love in the lab because we can kind of reverse engineer. Okay, this guy thinks like this and he's done this and that. So why don't you tell us your elevator pitch? If I meet you, Darin, whether it's online, in person, and I shake your hand, Darin, who are you and what do you do?
Hey, Ruben, appreciate you having me on the show.
Absolutely.
At the moment, my focus is I'm a multifamily syndicator. So what does that mean? That means that I look for large-scale multifamily opportunities to purchase and then raise capital from limited partners to be a part of the deal. You mentioned my background. I have another business that I've been in for about 18 years, trading residential, multifamily, and commercial real estate loans between banks. So I knew the multifamily asset class from my loan trading business, but I had not participated in purchasing real estate until about 2 years ago.
Nice. And I believe do you also have an accounting background? Am I correct?
Yeah.
I'm digging deep now. I'm digging deep.
You're digging deep. So I'm going to be turning 50 this year. So it's been a while since I graduated college, but I graduated college at University of Rhode Island. I grew up in Connecticut, so I'm originally an East Coast guy. And I studied accounting. I started with Price Waterhouse, got my CPA. Then I did some work within PepsiCo, within their international, both domestic and international audit division. Had a couple stops along the way before I got into the loan trading business. But yeah, I started out with the accounting degree and kind of transitioned through a few different corporate responsibilities before getting into owning my own business.
Excellent. So the reason actually why I'm really stoked to have you on the show, and I don't think I mentioned this in the beginning, Darin, but a lot of our listeners are entrepreneurs, real estate investors, and we like to kind of mix the two when we are in the lab because I'm a very big proponent of creating something sustainable and then using real estate maybe as a long-term kind of a legacy or income generating or wealth management, however you want to look at it. So I'm curious, you mentioned 2 years ago, it sounds like you've got a really good business, which we're going to get into. I want to get into the kind of the loan trading, which I think is fascinating. Why is there a reason why you turned to real estate? Why real estate? Why did it make sense?
Yeah. So I had an interest in real estate for a long time. But I never really wanted to do single family residential fix and flips. So I always wanted to get involved with larger real estate, and maybe in the last financial crisis, I was starting to look at some small strip centers, but I just never could get comfortable with the deal. And then I just opened up my own business in 2007, and all my focus went to growing that business. That business has been very good to me, and I like that business, but it's all the focus is on myself, my family, the profitability. It all goes to and there wasn't really the wealth generation that real estate provides. So I was always interested in that. And so about 2 years ago, I had some free time. My business was running efficiently. And so I wanted to go out and see how I can get involved. And I found a multifamily mentorship group based here in Dallas called the Brad Sumrock Group. And I joined that group. And, you know, the big bonus for me being a part of that was I just met so many people that had already done 1, 2, 3, 4 deals that I was able to leverage their experience.
Okay, that's interesting. I like that keyword, leverage the experience, because we're big on that. And I want to take a step back because you mentioned starting your own business. Was the business that you started in the same industry that you, I believe, worked at maybe as an employer, an employee? Excuse me.
So I was working for a large bank, Dutch bank called ABN AMRO,
Yep.
and they don't have a big retail presence in the U.S. So unless you're in the financial markets, a lot of people don't know that name. But at the time, it was 2002 to 2006, and it was in the big real estate run-up. And they had purchased a wholesale mortgage company and grew it to be a top 5 jumbo originator. So when I got involved, I ended up joining their mortgage capital markets group down in Boca Raton, Florida. And our responsibility was to take the loans that the bank was originating and then sell them to other banks across the country. And, you know, why would banks want to buy loans from other banks? Some banks are very good at raising deposits. So they bring in a lot of cash, but they're not able to make enough loans on their own. Okay. So they need to supplement and purchase some kind of asset. And so their option is to purchase securities, like mortgage-backed securities, or purchase loans from a third party. So yield-wise, we would kind of fall in between. So if they originated their own loan, that's the highest yielding asset that they can do. If they purchased a mortgage security, they're not going to get as strong of a yield. And then if they purchase loans from a third party, like us at ABN AMRO, then their yield would kind of fall in between what they would get on a mortgage back and what they would get if they originated their own loan. So that's the business. So I left that business when the market started to go, when the market started getting riskier. So our biggest competitors in that loan trading business were Countrywide and Washington Mutual, and they started to go down the credit channel and started originating a lot of stated income loans. And ABN AMRO, just from a credit perspective, decided they were not going to do that. And so we started to lose market share. More and more of the origination was going to our competitors. So I left the bank kind of 2006-ish. But in that 4 years, I was in a good place. It was people were buying what I was selling. The market was great, and I just put a lot of money away. So, I said at some point this will end. I don't know how or when or what will cause it. But, when housing prices are going up 10 or 15% a year and incomes are only going up 3%, at some point something's got to give. So I didn't know what I was going to do, but I just socked away a lot of money. So when things started to shift, I left the bank sometime in 2006. I played a lot of golf. I got my handicap down. I was looking at strip centers. I just couldn't find anything that I wanted to buy. And then about 6 months later, I started to reach out to some of my customers and said, hey, if I opened up a one-man shop, would you do business with me? And I kind of thought they were going to say no. Hey, Darin, you were with a large bank. But instead, they were like, look, Darin, if you could find me quality loans, I do business with you all day long. Our counterparty risk is really with the other bank who's selling the loans, and we're just going to pay you a broker fee. So I'm totally comfortable. So I opened up shop, and off we went. So I opened up shop in 2007. And for the entrepreneurs out there, or the would-be entrepreneurs out there, one of the questions I get asked a lot about starting a company, what was the hardest part?
Yeah.
about starting a company. And I say signing the lease to my office. And people are like, what?
Yeah.
Like,
Could you elaborate on that?
Was that a big financial impact? Was it a long-term lease? Like, why was that such a big deal? And the big deal was once I signed that office space, I put the shingle out there. I had to tell my friends and family, I'm in business. I had to tell my past colleagues, I'm in business.
Yeah.
So at that point in time, that's when like the clock starts ticking and that fear of failure, comes into your mind. And so signing that lease was a big deal to me. Now, what I'm here to tell those entrepreneurs that are listening, that you have the idea, look, once I got into that office and I started dialing for dollars and making calls, it was no different than when I worked for somebody else.
Yeah.
Except for all the profit was now coming to myself instead of just getting a commission.
Yeah.
But, making that leap and taking that chance was a big step. And I realize what a big step that is for a lot of people. And a lot of people can't get over the hump. And getting into real estate is like that as well. So there's a lot of similarities to that.
So you hit so many good points, and I'm here in the lab just taking notes, trying to like make sure I keep track, because you're leaving so many gems in here that I want to trace back to. So you mentioned that you pivoted in 2006 in 2007 after you transitioned to work for yourself. And the key word that I heard in there was that you had previous relationship with it, which I think is big and still applicable today when we fast forward into where you currently are. But I do want to take a step back because I think it's fascinating. I work with lenders, mortgage brokers, etc. But I haven't really heard too much about the loan trading side, which I'm familiar with.
Right.
So I don't want to let that escape for a quick second. Just so I'm clear, the folks that are trading these loans, are they doing it in bulk? Would it be, or individually? Is it your mom and pop 15 to 30 year mortgage? Let me buy that off, and then they'll get the principal out. Can you just explain that real quick? Because these are really, there's so many nuances and niches within the business. I don't want to surpass that real quick.
So first of all, let me just clarify that it's not selling to individuals. It's two banks that are
right.
There's a
B2B,
one bank
B2B.
One bank that's selling, one bank that's buying. It's portfolios of loans. So when I was at AB and AMRO, and it was no different in my business. Each bank that's the buyer has certain specifications on what they want to look for. So the first step is geography. So, some banks that are in the Midwest only want to buy Midwest loans. Okay. Some banks will look at, loans everywhere except for in the coast. There's each bank has kind of their own credit criteria. So one is geography, and then it may be the type of asset. Look, I'm not going to buy 30-year fixed loans because the duration is too long, but I'll buy 5/1 and 7/1 ARMs or 3/1 ARMs. So each bank has their own little criteria on what they look for, and then they're looking for certain yield parameters. In order for me to buy loans from you, hey, I'm buying this portfolio of loans instead of buying a security. And when I buy those loans, I'm actually taking the credit risk on that portfolio of loans. So I need to get, a jump in yield over what I would get buying securities. Okay, so when they buy mortgage-backed security, they may not have the credit risk. They still have maybe some prepayment, risk and reinvestment risk, but they wouldn't have the credit risk. So that I would try to marry up what the buyer's looking for with the inventory that I have
available
to sell. Yeah.
Oh, wow. And so just at a high level, just because I'm very curious, and I'm sure folks can look more into what your company does as well, but is it, if you're calling, Ruben Bank, or maybe let's say I'm calling you, is it, hey, do you have a dozen loans that fit my criteria, would I come to you, or am I picking, okay, I'm going to take 3 from Darin and 5 from, Bank of America, and I'm going to just, it's going to meet that minimum requirement? I guess I'm curious as to the level of the baseline that you need to meet when you're buying.
Yeah. So, this transaction sizes, could be 10 to 25 million, or it could be 25 to $100 million portfolios. And it depends on the asset class, so if you're talking about residential jumbos, you may have the average loan balance be, 500,000. So, if you're talking about selling a portfolio of multifamily loans, the average loan balance might be, $1.5 million. And if you're selling single tenant commercial real estate loans, the average balance might be 3 million. So it kind of depends on what asset class you're looking at.
Okay.
And also geography. If as well as I do, homes in California are substantially more expensive than homes in Dallas.
Absolutely.
So if you have a loan that's on a California property, typically the loan balance is going to be substantially higher than the loan balance on a Texas loan.
Excellent. Okay, great. No, that's a good high level, and I'm sure folks can have a look at what you're currently doing today, because you're still currently running your own a business trading. Is it called wholesale loan trading, or is it whole loan trading? Whole loan trading. Yeah. Okay. Excellent. That's fascinating. So let's fast forward again. So this was going back to 2007. So now you got your own business, and then. And I want to transition into, you put the shackles, you committed, you're ready to go. Now it's boots on the ground, you're doing your thing. Transitioning into real estate, it seems like you got some form of education first. Do you want to talk about that transition? Because you talk about that commitment process, but what did it look like as far as going to that next phase while you still have your business and going into real estate?
Sure. So early on you had asked me, hey, when you started your business, did you start from an industry that you were already in?
Yes.
And the answer was yes, right? So I ended up starting my business with expertise that I had from working at AB and AMRO. Well, when I decided that I wanted to get into real estate, and I didn't want to do single family fix and flips, I wanted to do larger scale properties. My mentality was, hey, I want to find a way to learn from others. I want to leverage the experience of others. So there's got to be a way to do that. And so when I found this group, and I was just lucky that it was based here in Dallas, I actually happened to go. So I went to a meetup group. I first went to a meetup group, and it ended up being a bunch of residential. So that didn't work. But then I found another meetup group that was focused just on multifamily. And when I went into that meetup group, then there was probably only 20 or 30 people that showed up for this meetup group. It wasn't like it was a 200 person event. And but I met a couple there, and they were gracious enough to spend half hour, 45 minutes talking to me. And they were like, hey, Darin, we were in the same position as you. We were business owners. We were looking towards retirement, and I'm not looking towards retirement, but they were looking towards retirement, and they saying that, hey, our nest egg just wasn't what we thought it would be, and we wanted to grow our wealth, and we had heard that real estate was a way to go, but we didn't know how to do it. We joined this group 3 or 4 years ago, and then they went on to describe to me, we did our first deal, we made X amount of money. We did our second deal, we made X amount of money. We did our third deal, and I couldn't believe how open they were with me in terms of how much money they made, how they didn't have the experience, and that they leveraged the experience within the group. And I was like, if they can do it, I can do it. So I ended up signing up the next week, and I once I signed up, I looked, I was never on social media. Okay. So 2007, end of 2017, right? The end of 2017, had not been on Facebook, was not on Instagram, nothing. And I joined this group and they tell me, hey, you need to get on Facebook because we have this private Facebook group with all the members. So I do. And all of a sudden I see the value. I'm like, holy cow, I can look at all the members and I can see the posts and I can tell who are the passive investors and who are the actual lead sponsors, the ones that are putting these deals together. And so I started to, take notes on who all the syndicators were. And then I reached out to them through Facebook Messenger and asked them to meet with me at Starbucks. And so I set up over the next 2 or 3 weeks, maybe 5 or 6 different meetings with guys who had already done it. Okay.
And
so
Darin, while you're talking, I want to make sure I piggyback it. Why was it so important for you to want to be an active investor? Because we know very well folks who are in business who are in limited partnership. Do you want to talk about what you see as the value in there and why it was important for you?
Yeah. So I did both, and I'll talk to that. But for me, I was looking to, I had some free time. I was looking to actually, I like to do deals. I like to do deals and I like to build relationships. And so the active side of the business was attractive to me from that perspective. And also there's when you're active, you have a bigger financial opportunity as well.
Yeah.
So that's why I really wanted to get to understand the active side. So when I met with these folks, I picked their brain, and then at the end, I asked all of them the same question. I asked them, first I stated, hey, I know why I would want to work with you and why I'd want to partner with you. You've done 3 deals. You have relationships with property management company, attorneys. You've raised capital. You know how to manage the asset afterwards. So it's a no-brainer for me to want to partner with you. But why would you ever want to partner with me as a new guy? And they all answered the question the same, which surprised me. So I didn't know the answer, but they all answered the same. They said, bring me the deal. So I wasn't really sure. I'm like, well, look, you're doing deals. Why do you need me to bring you a deal? Right. And so they all explained, look, I'm on my 4th or 5th deal. I'm looking at, 200 plus unit deals. You're probably going to be focused on 60 to 100 unit deals. I'm not looking at any of those deals. If you go and do all the legwork, meet with the broker, go do the property tour, underwrite the deal, get the budget from the property management company, get the quotes from the lenders, get it approved through a coach internally, do all that legwork, and then you think that you have a really solid chance of winning the deal. Well, if you call me at that point in time, right, you've already done all the legwork, and I wouldn't have done that deal anyway. So now I just spend a little time with you to understand the opportunity. I review the underwriting, and then if I like the deal and I like you, then I agree to partner with you. Well, now you send me your resume. I attach your resume to mine, and when I submit the offer, we're a team, and now I've got an experienced guy, experienced syndicator on my team, which is much more attractive to the seller and to the broker. Okay. And so it's a win for me as a new guy being attached to somebody that's experienced, but it's a win for them also, because if we win the deal, he or she is going to get a piece of the deal on a deal that they wouldn't even have been looking at.
I love that. That's so important because we talk about, adding value all the time, and essentially that's what you're doing. You're doing all the legwork. They're doing their thing. Everyone's busy. Everyone's focusing on their project, but you're doing all the legwork and you're bringing something to them that I think what I really like there and that you cover is it is a different asset class or gap that they're not really focused on, and so you're able to just add on to their portfolio
Right.
by just doing the work up front, which I do like very well that you stated that, because I think sometimes a lot of people want to take without giving, but you gotta put up the work first.
Right. And the flip side of that too also is because I've had a lot of sidebar calls with people that reach out to me on Instagram, and mindset is extremely important. And there's a lot of people that want to get into the business that have sold themselves that an experienced person isn't going to want to work with them.
Yeah.
Like, look, I have no experience. Why would they ever want to work with me? Well, I just told you why, right? So, getting past that mindset, where you can add value to these people, right? So you can complement one another.
Mm-hmm. Darin, I want to make sure I touch on this, because when we come into the lab, I like giving tactical, practical advice, which you've already done. You're already a step ahead. But what may one consider? And again, this is no attorney advice. Obviously, everybody gets your own attorney. But just as a hindsight, what may be a good way to structure that if you're working with an experienced person? Is that a joint venture, or are you bringing them on as they're the limited partner? Tell me about how that would work if you're bringing a 60 to 100 unit deal to someone who's very experienced, and maybe you don't have enough capital, to raise the capital. What is that deal? What may it look like, that structured deal?
Sure. So if you've looked at syndications, there are a lot of different ways you can structure them. But I'll just talk to you about the deal that we did together. It was a 76 unit townhome community, and we structured the deal as a 80-20 split. And what I mean by that is 80% for the limited partners and 20% for the general partners. So in my scenario, I asked one other experienced syndicator, a guy by the name of Raj Gupta out of Chicago, extremely experienced, very smart guy. I'm very happy and blessed that he was willing to work with me on that deal. In any event, so Raj and myself would encompass the 20% general partnership. Now, that, the split within that can be whatever you negotiate with, the other partner. If you feel like you're doing, bringing more value, if you feel like it's an even split, you could split it 10%, 10%, or you can split it any which way. It's just a pure negotiation between you and the partner that you're bringing on.
Mm-hmm.
And I think that answers your question.
Yeah, sure. I think.
So then the limited partners on that deal, we brought 44 limited partners to invest in that deal, and we raised it was about a $6 million purchase, and we raised like $2.5 million, and from 44 limited partners. So,
okay, so it was just so we put things into perspective. Was Raj the GP? Was that the one who had experience that you decided to go in on with? Okay, great. Just want to make sure that we understood that, because that presents well, especially when you're presenting a deal. Who are the the general partners in the deal who are driving the deal, right?
Right, and I would tell your listeners now. We're in the middle of this coronavirus, and real estate is kind of taking a little bit of a pause, and we're going to see how it impacts cash flow and valuations and all of that. It's most likely going to change, but up to this point, it's been extremely competitive in the high unit multifamily business, and so some people would call me and say they want to get into that business. And I would tell them, you will not win a deal. Okay. You will not win a deal in that large unit multifamily space unless you partner with somebody who has experience or you completely overpay.
Can you define large for you? Because I think to depending on, that's very subjective. What do you
It is subjective. And I didn't come up with this line in the sand. I got it through the group that I'm a part of, but
absolutely,
they kind of set the line in the sand as 60 units. Okay, so 60 units or above. And the reason for that is that typically a property that has 60 units or greater, you can afford within the budget to have a full-time leasing person on the property and a full-time maintenance person on the property. So, if you buy a 30-unit property, it could still be a fantastic opportunity, right? But you have to figure out, you can't afford full-time staff if you have a smaller property, a 16-unit or 24-unit or 32-unit. And that's fine. There's, some people, they go down that path and, they get more involved. They're more a part of it. But I like the scalability of getting into the larger properties, because if I have full-time staff on the property, then once I get that property stabilized, then I can go on to the next deal. And I know that the day-to-day is being run by that management company.
Now, when you say full time, and I know, I think some folks might be listening and might be thinking this, because there's a quintessential, 8% to 10%, management fee that you factor in out of the gross income that's made from the property. Are we talking that it's beyond that at the 60 unit level, or do you mean that under at 30 you that number is skewed and the 8% wouldn't cover someone full time? You want to talk about that, because I know people hear that a lot. The management fee is typically 8 to 10%, but talk about 60 plus. What does that look like? Is that still 8%? Is that more? Is it factored in with the gross operating income of the property? Can you give us a little insight on what you meant by that?
Yeah. So as I mentioned before, when you do the underwriting, before we put an offer in, we'll actually go to the property management company that we're going to use and ask them to put together a budget. Okay. That budget will include all the expenses to run the property, including their management fee. Okay. So their management fee, the utilities, property taxes, insurance, and payroll. Okay. So payroll would be the payroll for the leasing person, and also payroll for the maintenance person. And so to answer your question, as you go up the scale on larger properties, the management fee is actually less. So our management fee on a 76 unit property is 4% of collections. Okay. Now when you get into 100 plus, it drops down to 3.5%. When you get into, I don't know the exact line, but maybe 150 or 200, now you're down to 3% management fee. So the management fee definitely goes down as a percentage, but you're factoring in, so you have the management fee, but then you also have the payroll cost. So although the employees are employees of the management company and they're cutting the check, the budget is actually comes out of the property. Okay. Yeah. So the management company will pay the employee, and then they'll take out the expense from the actual property.
I appreciate you explaining that. That gives real clear insight. So I want to transition into what you talked about. Getting a general partner that's experienced in the game will get you through the doors, because as we know, it is, call it what you want, Wild Wild West, whatever it is. And the reason I say Wild Wild West, we're talking about international investors. Like no one has multifamily apartments like the way we have it here in the US. And you mentioned Canada. I actually spent some time in Canada. Same thing. They don't have that much, right? So United States is a primary target for all investors. So it is very competitive. That's one. Talk about, you are, you've done a lot. And I see general partner, I see limited partner, I see key partner, key principal. At what point, would you say someone initially should they go in as a GP? Should they go in as a LP? Can you maybe identify the difference between all of those for those who are listening as to, hey, what may be a good way for me to enter into this game? And what's the best way for me to actually learn and maybe partner with people?
Good question. So
loaded question.
Right. I'll try to answer it a few different ways. So one, the different ways you can get involved, okay, are you can invest as a limited partner. Okay, that's one way. Second way is you can just go out and buy, you know, a 4-plex or 8-plex or 12-plex, whatever you could afford, and just buy your own asset. Okay. You could become a limited partner in a deal, but also sign as a key principal. Okay, so if you become a key principal, you're signing on the loan, okay, of that asset, but you're still a limited partner. Okay, and then the last way is you're a general partner in a syndication. Okay?
Got it, which you just touched. And I want to just stop you for a second. Why would someone want to be a key principal? What are some of the advantages of being why would you take on that risk?
That's a great question. And it's funny because, so I joined in 2017, December 2017, January, I invested in my first passive deal. Okay. And then about once a month, I was investing in other passive deals because I wanted to learn. And after like 3 or 4, I was trying to become a key principal as a passive, and my wife's and I would miss them. So a deal would come out, I would respond to the syndicator, hey, I'm interested in becoming a key principal on this deal. And then they'd respond back, Darin, hey man, I'm sorry. We've already got all the key principals we need. And then I go on to the next deal. Hey, I want to get, my wife's like, Darin, am I understanding this correct? Like, you are fighting to become a key principal and you're not going to get any additional compensation for it. But you're taking on the risk of signing on the loan. I said, I know, it's crazy. The reason why people want to do it is because most of the loans that we're getting through this group, not everybody does it this way, but most of the people in our group focus on agency financing. So Fannie and Freddie, long-term fixed rate loans, and they're non-recourse loans. Okay. So what does that mean? That means that Fannie and Freddie, as collateral, can, if there's a problem, can come back after the asset. So if we can't pay the mortgage and we go in default, they can come after the asset, but they can't come after Darin Batchelder personally. Okay. And there's certain bad boy carve outs, they call them, if there's like fraud or something like that. But if you're running the business properly and you're straight up and it just goes bad, they can't come after all your personal assets. Now, if you go get a bank loan, you're going to have to sign a personal guarantee and they can come after all your assets. So the reason why people wanted to become a key principal is because Fannie and Freddie, when you do become a general partner, okay, they really are reluctant to do a deal with anybody if they don't have experience. Okay, so if you are a key principal on somebody else's deal, now you're in Fannie or Freddie's database as a key principal.
Got it.
And so you're kind of given credit for being a part of that. And so then they see that you have some experience, and then they may be more willing to do business with you. So that was kind of the path that was outlined to me when I joined this group. Get involved as a passive investor, then become a key principal, then become a general partner. But now that I have the experience of going through it, I actually would advise you don't need to become a key principal first. And here's the reason why I would say that. In today's market, you can't win a deal if you're not partnered with somebody that has experience.
Mm.
Okay. So in my example, I partnered with Raj Gupta out of Chicago. He already had a ton of experience with Fannie, Freddie, all these different lenders. Well, me and him are partnering together. They look at us as a collective general partnership. He already has the experience. So the fact that I was a key principal on another deal, it doesn't even come into play.
Yeah.
Like it doesn't tilt the scale at all. If I was wanting to go out and buy my own 16 unit or 24 unit or something like that, then yes, go become a limited partner, get the key principal experience, and then go buy my own deal, put up all the capital myself. Fannie and Freddie are going to want me to have that experience. Okay.
Got it.
But
Yeah.
if you're going to partner with somebody with experience anyway, I don't think you have to do that.
Yeah, I was under the impression that a key principal gives you a little bit more access to what a limited partner might not have access to as a limited partner, because that's what.
Yeah.
And I wasn't sure if that's accurate. Would you say I was saying that correctly, or would you say there's a way that you can weasel your way in as a limited partner? Because you seem to have a smirk on your face. Why is that?
Yeah, right. So it's you feel that you should get more access, right? Yeah. You're signing on the loan. And that's another reason why a lot of people are fighting to become a key principal. They're like, well, look, I just want to learn, right? Yeah. So like when I joined the group, I was the same way, right? So I invested passively, and then I wanted to become a key principal. And each deal I invested passively, and as a key principal, I was like, to the syndicator, hey, I'm going to invest in your deal, but this is what I'm looking to get out of it. Not just the passive investment, but I want to learn because I want to become a general partner. And like one deal I invested in, it was an ugly asset. It needed had a lot of deferred maintenance on the outside.
Yeah. Had
cracks down the side of the building. I'm like, hey, I want to get involved. I've never done any kind of rehab. I want to get involved in the discussions that you have with your the companies that you're going to ask to bid on it, and understand, what's important and what the costs are associated with different variables. And Darin, man, no problem. We'll get you involved. And well, I invested, and then I'm not pointing fingers at them because I saw it after I did my deal. Like, you just get so busy that your priority isn't, hey man, come, join the party. Like, every time I'm going to have a conference call, let me call you first and, conference you in. So it's no fault to anybody. It's just that
it's not
all
ideal.
Those responsibilities fall under the general partner, and they're just going after and getting it done. And so their job really isn't the education piece, these mentorship groups and coaches and all that. Yeah, they handhold you a little bit more. The limited partners and the key principals tend to be, hey, we need your capital, and we're going to provide you with a, above average return.
Yeah.
And, that kind of ends that relationship. Now, do you get more access? They're going to take my call maybe over, a limited partners call, but
you're not getting to the nitty gritty of the.
Yeah, I wasn't able to leverage it to the extent that I thought I could.
Okay, so just to bring it full circle, if we're going to summarize that, then is the idea, if you are, because I know a lot of listeners probably want to get right in it and just maybe dive right in. If that's the case, would you summarize it and say then your best case scenario, because as a key principal or as a limited partner, you just don't have the luxury to be always involved in a day-to-day. They're not going to, like you said, conference you in. So is my best bet then to just do a GP with someone who's literally been in the game, and then you'll be able to share the books and share the knowledge on boots on the ground directly? Is that what you're saying was the best learning experience for you?
I would say, so I invested passively in 7 different deals, and for me, it was attractive to pull money out of the stock market and put it into real estate. I don't think you have to do, 3, 4, 7 deals. Look, if you have the capital, this is what I would advise is invest in one passive deal. Okay. And then decide you will learn a lot from being a passive investor. Okay. Just the process you have to go through. It's not like buying a stock. You have to, there's agreements you have to sign, and you have to review a presentation, and it's just a different process. So if you have interest in becoming a general partner at some point, well, you're going to have to raise capital from the limited partners. So I think there's a huge benefit to seeing it from their side, to understanding what their questions are and what their concerns are and what their fears are. And so I think that there's a lot of value in doing a passive investment with somebody else first, and then decide, okay, do I want to become a general partner, or do I just want to continue to invest passively?
Yeah.
And if you want to become a general partner, then I would advise you to do one of two things: either join a multifamily mentorship group, and I'm a part of one, but there's a number of other great ones across the country. And I've met some great syndicators in other groups. But if I talk to some young people that are like, Darin, I don't have the capital to do that and invest, right? So then I'm like, okay, well, it's just going to be harder and take you a little bit longer, but go to, download the app Meetup on your phone, put in multifamily investing or apartment investing, and start to go to some free meetup groups in your local area. And your goal of that meeting, there will be some education. That meeting will be, something, they're going to be talking about something. There's some kind of focus. So you'll learn something, but your goal of that meeting is to meet as many syndicators as possible.
Absolutely.
And you want to get on their investor database, okay, so that when they have a deal, they'll present it to you. But more importantly, you at that meetup, you want to set up a follow-up meeting with that person, because they don't have a half hour or 45 minutes to talk to you. They're going to be meeting all these different people. They have 5 minutes with you. You tell them, hey man, I'm interested in passively investing and possibly becoming a general partner someday. I'd love to understand more your experience. Can we get together for coffee? Well, that guy is looking at you as a potential investor in his next deal. He most likely is going to take that meeting, right?
Yeah.
And then you learn from that person. And then if you strike a balance where you think that you're developing a relationship, hey, if I got a deal, would you be open to partnering with me? Some people are going to say no. Okay, they're off the list. But you ask enough people, and now all of a sudden you build up 3, 4, 5 people that are on your list, that when you do find a deal, you can go to those 3, 4, 5 people as your experienced people.
Yeah, that's great. And I want to go and transition to the keeping it real segment, and at the same time, build on what you said about younger individual, maybe asking you, want to be part of this. One of the most fascinating topics, I love business and I love real estate. And if I'm a younger version of Darin and I happen to, maybe have interest in both, I love hearing the business owner talking about building his business and then investing in real estate. But if I'm young and I'm listening to this and I'm interested in both, what kind of advice would you give a young person who says, hey, I want to build a business. Should I be going into as a syndicator, because that is a business model, or should I build my business first and then use that money to invest in real estate? Like, what is the young Darin thinking? Because I'm sure that's a thought, and I love this conversation but where would you take that conversation and advise someone? I'm curious.
Yeah,
right or wrong.
It's a very good question. So I'll answer it a few different ways again. So when I talk to young people in their 20s, early 30s that are looking to get into the large multifamily space, and I say to them, I wish I had done it 20 years ago, right? So I did it. I got involved when I was 48. I wish I had done it when I was younger. Okay. I think that there's just so many tax advantages to real estate and wealth creating advantages to real estate that I wish I had gotten involved sooner. Okay. So that's one part of the answer. The other part, though, is it's much harder to do this business when you have no capital and no reputation and no experience. Like, you're raising capital, millions of dollars, right? So people are, you know, even this was my first deal. Well, a lot of people may not have invested with me if I had a, you know, experienced partner that they knew was, you know, side by side with me. But then there were other people with my personal network that were like, hey, Darin, you know, I've seen you've been successful with your business.
Yeah.
You know, I like you, you know, I trust you. I don't know this asset class. Help me understand it. You know, there's more education there. But when you're young, you don't have the luxury of either of those. You don't have the experience to be able to, you know, prove yourself, and you don't have the capital to be able to invest in these deals. So predominantly the people that I see that are in this business are, you know, 40s, 50s, 60s, right? But I do know a few, again, the number is much smaller, a few people in their 20s that have found a way to be successful in the large multifamily syndication business. And the way they did it was grit and hustle and networking and putting themselves out there and determination. So if you're the younger guy, your percentage opportunity for success is much smaller. Mm-hmm. So you have to believe that you are the top 3 to 5%. Yeah. That is gonna make it happen. If you're that guy, I don't think there's a better place than real estate. And there's a lot of people in the group that educated me, and I thought I was pretty financial savvy up to that point. But when I look back on the amount of taxes I paid, okay, through, you know, being successful in software sales and in the mortgage trading business, and then when I started my own company, you know, in all those different avenues, you know, I was very thankful to be successful, but I stroked a big check every year to the government. And in the real estate world, you know, there are strategies that you can put in place that can shelter a lot of that. So I think about all those years that I've been able to take that money and not send a big check to the government, but invest it in real estate and then have that compound over the years, is just tremendous opportunities. You know, whether it be, you know, if you own your own assets, rolling them over in 1031 exchanges, yeah, you know, or in these syndications, there's the opportunity to have massive amounts of depreciation early on in the asset life that can cover, you know, other income. So it's not a completely clear answer because it's dependent on the individual. Yeah. If you're in your 20s, I would say you have to be an extreme go-getter to be successful in large-scale multifamily, but you can do it. You can do it. And if you think you can do it, I don't think there's a better place to be.
Good stuff. I love that. I love how you tied that full circle. Let's transition to the core rapid fire questions. So we covered so much here, and I love the extension of your answers because you put a lot of thought to it. So I do appreciate that. These are rapid fire questions for you. So
I will try.
No worries. What is your favorite book? And I see before, if you guys are listening to this and you're driving, Darin has a fantastic library here. I see Tim Ferriss in the background there. I see a few good gems. But what would you say is probably one that you one of your favorite books?
Yeah, so what is it? Tools of Titans. That one is an awesome book, and it's an intimidating book because it's big. So I bought it and it was sitting on my bookshelf for a while.
Same.
And I was intimidated to just start it. But what I did was I incorporated it into my daily routine. And so every morning I get up and I read one book of the Bible, and then, and I pray, and then I read some kind of business book. And so that book is a collection of like the best podcast episodes that Tim Ferriss put together with all different types of people in all different types of industries. And what I liked about the book, and he actually says it in the forward, he's like, look, you could skip around if you want. You don't have to read it,
Absolutely.
page 1 to the end. And so he broke it out into 3 different sections, and I would read one person from each section every morning, and it's only 2 or 3 pages per person. And so I would tell my wife, I can't wait to meet the next 3 people tomorrow. And she was laughing at me, and I'm like, because I'm reading and I feel like I'm actually getting inside their head and being able to leverage the wisdom of all these different people. So I know that was not short fire. So I warned you that
Yeah, you know what? I love it because I feel like I'm looking at myself. I didn't think I'd meet anybody else who's just I could talk for days. No, I love it. That's you couldn't have said any better, because I experienced the same thing. There's so many interesting people. And did you come across Jamie Foxx?
Yes.
Yeah, it's just so many fascinating people. You just have no
fantastic
idea, right?
people in there.
Yeah. No, I would recommend that. Awesome. You read my mind. The next question I was going to ask is, what is the best habit that serves you every day?
So for me, it's starting by reading the Bible.
It's good for you.
And is that surefire? Can I?
Yeah, no, I like it. No, I wasn't going to cut you off. I gave you my timeline. I'm good. I can keep going. But what is the best tool that helps you excel throughout your day? It could be technology. It could be an application. I just like to hear it from you.
I'm not sure if I have a best tool. What I would say is that I have the mindset that I'm going to be successful.
Nice.
And that sometimes people ask me, what's the first thing that I need to do? And I'm like, you have to tell yourself that you're going to do it.
Yeah. And
until you make that decision for yourself and see yourself there, it doesn't matter what anybody else does for you. So there's just like anything, you have setbacks and you have to get back up, like there's in the last year, I think I was runner up 3 times, and each of those times I thought I was going to win the deal, right? I put in so much work and effort, and so it's a letdown at first. You don't win the deal. It doesn't matter if you're second or if you're 12th. You don't win the deal. You don't win the deal. And so, but you got to get back up, man. You got to get back up and go after the next one.
It's a marathon. Absolutely. With that said, I know your asset class, but this is a scenario: 1 300-unit apartment or 3 apartments of 100 units. Why?
3 apartments of 100
So
units.
one 300-unit apartment.
Okay.
Or 3 different apartments of 100 units. Which one would you pick?
Well, I think that for me, it's going, and this is part mindset too. So for me, I felt like my biggest opportunity was 60 to 100 because I wasn't competing as much with like the senior syndicators. But that's mindset also, because I've seen other people just skip that altogether and go right to 200 to 300 unit and win deals. So for me, I'm like, okay, 76, I want to do 100 plus, then I want to do 150 plus, 200 plus, 300 plus, then I want to do a portfolio. Then after that, maybe I get into a different asset class, so for the answer to that is I would do 3 at 100, because my mindset is, I feel like I can do a 100 unit property now, a 300 unit feels a little bit of a stretch.
Yeah. It's interesting. I asked this question to almost every investor that comes on here, and I get a, I would say 50-50 answer depending on where their mindset is as a maybe as a syndicator, as an investor. They're thinking either, I've heard different answers, so I think it's really fascinating. Maybe we'll save that and we'll compile it next time. I think I've done that. Cash flow or equity?
I think both, but I mean, in today's market, cash flow is becoming more and more important because when you're at the tail end of a real estate cycle, how much further can equity really grow? But I'm a big believer in Dallas. I'm originally an East Coast guy, and I've been here for 10 years, and I kind of have the Warren Buffett view. I don't know where it's going to be in 3 months or 6 months or 2 years, but 5 or 10 years from now, I have a ton of confidence that there's going to be a shit more people living in Dallas that, and with that growth in population, there could be no other way than to have real estate prices go up, rents go up.
Yeah.
So I don't know if that answers your question.
Yeah, absolutely. Self-manage or outsource?
Outsource.
Cool. If you had one superpower in your business and real estate, which one? What power would that be?
I don't know about the real estate business, but I'm reading the book about what's your why?
Yeah.
Right. And I started writing it down, and for me, there were really two facets. One is financial freedom. So that's for most people that are getting into this space. Like, I just want to be free of time and money and all that. But the second piece is really inspiration. Like, to me, if I can inspire one person to start that company, buy that real estate asset, write a book, record that song, that, just being a human being in this world, that brings me a ton of joy to be able to help encourage somebody to go after their dream.
Yeah. That's deep. And I respect you for that. I think a lot of people who are in this place are playing a bigger game for a bigger reason. So I commend you for that. Good for you. Transitioning into the insider secrets right before we drop, we talked about the current state that we're in right now. We touched a little bit on it. Obviously, there's a virus that's impacting us in ways that, again, we don't really know how bad the impact is going to be or how long it's going to last. Right now, it's just we're speculation. But what are your thoughts as to or what are some direct impacts that you've seen in your market or in your day-to-day? Again, I'm not sure how close you are to, I know you've worn the asset manager hat, principal, key principal. So what is and maybe an asset manager doing right now? If people are you guys experiencing an impact with folks depending on the class, the asset class, maybe, who are directly impacted, and how you're dealing with it in-house?
Yeah, definitely impacted. So, as the lead syndicator on a 76 unit property, there's the tenants, 76 people that are living at that property. And, I'm sure there's people on the property that are going to be impacted financially, okay, from their jobs related to the virus. Then there's the 44 limited partners that entrusted us with their capital to invest in the deal. And so we're a steward of, their funds, and, need to manage the asset to provide certain returns and protect the valuation of that asset. So we're trying to weigh we want to do the right thing for people that are impacted. We also need to pay the bills. So we're hopeful that a lot of the tenants are actually going to pay rent. We don't know. So it's March 30th today. We had a great February. We had a great March. But this thing happened mid-March. We had already received the March rent. So we're going into April, and the government has put, there's no more, for a period of 90 or 120 days, there's no more evictions. So we don't know how, bad this is. We know our cash flow is going to be impacted negatively, but we don't know to what extent.
Yeah.
So the first thing, that we did is we let investors know, hey, look, although we're in a good cash position, we're not going to pay out distributions this quarter because we're going to wait to see our cash flow position and how it progresses. If this is 1 month, it's not a big deal. If this runs into 3, 6, 9 months, you're going to see a lot of property owners have a problem, paying the mortgage. So time will tell, but that's, we're right in the middle of that right now. These next 2 weeks will tell us a lot in terms of, now our on-site, I've been daily talking to the on-site property manager, and she has provided me guidance that, hey, Darin, the tenants are, telling me that they're still planning on paying rent. And so, I don't think it's going to be that dire, but, until we see the cash flow come in.
Actions speak louder than words, right?
Right.
And hopefully that, for everybody, you don't want, obviously, your tenants caring about them. Their situation will kind of create a domino effect, which, is a tough one. So, and I think I've had a lot of folks ask me that too, and obviously I'm very less qualified to answer that question, but considering them in real estate space, I think we just don't have enough data at this point. So it'll be interesting to maybe ask the question. Yeah.
On the flip side, on the buy side, it's also changing the world up because, when you buy, say we go under contract, I get awarded a deal today, okay, and we have 60 days to close. Well, the lender, Fannie and Freddie, are going to not only look at the cash flow of the property today when I get the asset, but they're also going to look at it as we're going through the loan approval process. So those buyers that are in the middle of a contract right now, okay, their lender is going to look at April cash flow. And what's going to happen is cash flow is going to go down. I don't know by what extent, but it's going to go down. And then the lender is going to say, okay, well, we need to factor in that lower cash flow into our analysis. And so they're going to come back and they're going to say, I know we said we were going to provide you with a $5 million loan, but because your cash flow has gone down, now we can only provide you with a $4.5 million loan.
Absolutely.
Well, that means that buying group has to raise another $500,000 worth of equity from limited partners. So, there's definitely going to be an impact, on the buy side as well.
And Darin, I'm so glad you brought that up because in the large multifamily space, we look at, the rent rolls and in the last, usually the year, but are you saying that they're going to assess it a little bit differently, or is that best practice where they actually when you're under contract, this is something that would enlighten me and some of the listeners, they're actually still looking at on the actual month in itself, or
that it's not a change in process. Okay. It's just going to be a change in cash flow. So, what the lender typically does is look at, what we call the trailing 3. So the trailing 3 months. So they're going to look at so now I get the asset under contract right now. They're going to look at the last 3 months, and that's what they're providing guidance as to, here's the type of loan we think we can give you, the loan proceeds we think. Well, this has always been the case. Okay. If you go under contract, as a buyer, you're at risk that the current ownership group doesn't maintain the same level of cash flow.
Yeah.
So if the cash flow goes down, while you're going through that approval process, your loan proceeds will go down. And that was the case before the coronavirus.
Yeah.
But the big deal here is that cash flow is going to go down substantially more than anything before.
Yeah.
So it's going to change up loan proceeds, and going forward, it's going to change up valuations in one way or another.
Wow. That was the perfect Insider Secrets segment we've had, because I think it's very real, and I think people get a lot of value from that. So I can't thank you enough, because I really do appreciate it. And I know we've been on here for a long time, but you give a lot of value. Lastly, I know we connected on social media, and I'm not sure, are you very active on social media? Is that where people can find you, or is this a new thing for you? I know we talked about it a little bit.
Right. So the best way to reach me is Instagram. Instagram is the platform I'm on more than others, and my tag is at Batchelder Darin. Mm-hmm. And I don't know if you will include that in your show notes.
Absolutely,
or
we will.
But funny you asked. Like, earlier I mentioned, before I got involved in this multifamily group,
yeah,
I wasn't even on Facebook, right?
Right.
Well, about a year ago, I'd been going to a bunch of entrepreneur conferences, and they were not related to real estate, and they were all saying, if you're not on Instagram, you're just missing out. And I'm an old school business guy. Like, I'm used to like getting on a plane, flying someplace, shaking somebody's hand, or at least over the phone. So Instagram, I always thought, I've got two teenage kids, a junior in high school and a freshman in college. And I saw them, from middle school up using Instagram. And I just thought it was like a picture tool, right? And I couldn't see how to use it for business. But I kept hearing it over and over again. So kind of like what I did with the multifamily business, I said I wanted to get into large scale multifamily. I went and found a group that had done it, right? So Instagram, I went to a conference, and I said to my wife, I said, when I go to this conference, and I also said to my men's group that I'm a part of, I said, I'm going to this conference, and one of the main goals is I want to meet somebody at this conference that is strong in Instagram, and I want them to teach me. And sure enough, I met somebody, and I ended up hiring him to consult with me. I just told him I have no idea how to do this. Yeah. And so I consulted with him for, I don't know, a month or so, and maybe one call a week, maybe for a month or so. And he helped me get started.
Good for you.
And it was very uncomfortable at first. He was like, you have to post every day. And I'm like, what am I going to post about? And so that routine about reading the Bible, after I read the Bible and business book, now it's just habit. I post to Instagram right after. So it's like brushing my teeth. Brush my teeth, read the Bible, post to Instagram. But the first month and a half, 2 months of that it was uncomfortable. But now I've met so many great people out of it. So I realized there are some people, there's going to be haters. There's going to be some people that are going to criticize for doing certain things. But I've met so many great people. I have a guy from Spain who called me and wants to invest in multifamily. Chicago, Las Vegas, all over the country. I never would have met these people had I not put myself out there. So I think it's a fantastic tool. And the two of us would never have met probably.
Absolutely.
Had it not been for Instagram. So
I
appreciate getting to know you, my friend.
You too. And honestly, again, genuine vibes. You can feel it. And I can't thank you enough. The people will definitely follow what you're doing, connect with you on Instagram. I think there's a lot more knowledge to come from your way and a lot of business insights. And last but not least, I always like to say, if I can ever make an introduction or help you with anything, is there anything that comes top of mind right now? Because you seem to be a very resourceful guy, and I'm usually just I'm as good as my connection. So is there anything that I can do for Darin?
Yeah, I mean, the goal for me in putting myself out there on Instagram and social media is to get the word out about, I'm looking to get the word out because about the syndication space, okay, that you have an alternative to investing in the stock market and in these private placement deals. And, I'm one resource, okay, and I could be used as a resource to bring you along and invest as a passive investor.
Yeah.
But I'm also a resource that I'll get on the phone with you and just talk to you about how you can get involved as a passive or as an active investor. And so whether it's with me or with another syndicator, I really truly believe in real estate, and I truly believe that multifamily real estate is an incredible asset class because people have to live somewhere. Right now in this crisis, people are having to cut expenses, right, and try to figure out how to survive. Well, the expenses that they're going to have to keep are rent, their car,
exactly,
food, and then they're going to start cutting other stuff. In any event, that's what you could do for me. If you have passive investors that are looking to get, in the game, I would love to get on the phone with them and talk to them, develop a relationship, and potentially do business together.
Absolutely.